Shah, over the next 30 minutes or 25 minutes, we'll talk all about mutual funds. But before we start talking about mutual funds, it's important to put something into perspective. And that is what's happened to ITC. While we get in experts to talk about the best mutual fund strategies to deploy, here's the news on ITC. British American Tobacco is looking to monetize some of its stake in ITC. Let's go across to Sajid Mangat for more on this. Sajid.
That's right, Niraj. The BAT or British American Tobacco is looking to monetize some of the stake that it holds in Indian FMCG and cigarette maker ITC. Basically, as part of the earnings statement, BAT has released that it plans to monetize some of this stake, which in ITC over a period of next few years, and is working with the regulators to ensure that it gets the due permission for that. To put in context, it's planning to offload roughly around 4% in the ITC. It holds nearly 29% stake there. It's one of the early investors of ITC from early 1900s, and over a period of time, it has gone up to 29%. And now it wants to, bring in little capital efficiency, because the value of the stake is now valued at roughly around $18 billion or 1.5 lakh crores, and it plans to use that as part of its cash management or capital management, where it has told its shareholders that it plans to generate over $43 billion before dividends over the next 5 years. Niraj.
Okay. Sajid, this comes at an interesting time when ITC for the longest time hadn't done anything and now has had a significant up move. So the timing is clearly interesting that they're taking advantage of the fact that ITC is no longer the laggard that it used to be.
That's true. Also, the fact that there's a demerger in process for the ITC hotels, which comes in, and BAT would be getting a stake there in as part of the shareholding in ITC hotels as well. So, and ITC hotels is not going to be a core business for BAT. So, when that demerger happens, it seems that BAT will look to monetize that stake as well.
Okay, Sajid, thanks so much for putting that into perspective. On today's edition of the Mutual Fund Show, we are joined by Kalpen Parekh, MD and CEO of DSP Mutual Fund, and Vineet Samre, Head of Equities at DSP Mutual Fund, to talk about a very interesting note. It's an annual note 2024, which they have titled A Winning Team. And amongst things that we will talk with them on the show is what they are talking about as insights from the Tour de France for a thoughtful portfolio approach. I saw the report and I was like, we have to do this conversation. Lend itself to a little bit of mutual fund investing as well, because we're talking on the Mutual Fund Show. Kalpen and Vineet, thank you so much for joining us today. Kalpen, let me start with you. What was the genesis of writing a note like this with such a comparison of insights from a major sporting event?
Thanks, Niraj, for firstly inviting, and more importantly for deep diving on a very detailed document that Vineet and team have come up with. So since the last 3 years, we've been coming up with an annual document, which mainly is about our reflections from the year which went by and our observations on, broadly data points, trends which are playing out in the world of investing. So this annual note is actually meant for us to, improve our learning, our reflections, and transparently share with our investors and marketplace what we are thinking about. And this is also a point in time where many turning points are there. Many beliefs are getting questioned and challenged in terms of, a certain part of the market becoming frothy, some part of the market remaining, reasonably safe in terms of margin of safety. So this note allows us to put across our points of view. Also at DSP, as a 27-year-old asset management company, it is over time leveraging a lot of data technology along with fundamental experience of our teams. So the whole concept of a winning team was to see that how can we try to marry both together and, take certain investment decisions or get inputs on a daily basis, which can help sharpen our decision making and improve. And we've given a lot of examples in the note. So I think that was the backdrop, and glad that you invited us to talk about it.
Pleasure is ours. Vineet, you want to add to this? Vineet, you want to add to this?
So again, thanks for inviting us today on the show. So see, I think why we actually picked up this theme. More importantly, also beyond what Kalpen mentioned, is the fact that we wanted to highlight two important messages out here. One, just like in case of these sporting events, there is a team effort which actually leads to success. Here we want to drive the fact that the whole DSP team as such, including our core investment team, I think the divergence of knowledge what these team actually gets in, the divergence of skill set what these team gets in, allows us to think maybe in a more variable manner, think more differently, and that is what is maybe defines how the long-term success has to happen. So that is one aspect why we have aligned. The other aspect also is the fact that just like in case of this sporting event, there is a team effort. Here also what we are saying at this juncture, when the valuations have reach where they are, some part of the markets are a little expensive, it's also good to look at diversified asset class to maybe bring your portfolio more into a aligned manner given the current valuation, and also to see that long-term success will be a factor of how your asset allocation strategy today is defined, rather than just taking a call on a specific segment which may be doing well today. So that's the overall thought process.
Now, Kalpen kindly mentioned that I have already done a deep dive. I've obviously not done as deep a dive as you would have liked, but I'll still try and pick up the 3 or 4 key aspects that at least we thought were relevant to talk about today. And we're trying to correlate them to how can a mutual fund investor per se, take insights from in her or his investment journey. So let me try and understand from you guys. You've spoken about how 2023 was a year of mid caps and small caps, and either of you can take this answer, but could it happen again, looking at insights from a sporting event and looking at what's happened in 2023, that an encore could happen, or should a person be careful about that space now that that space has done so well? Either of you.
So let me start before Vineet adds, and I want to give a disclaimer that if you had asked this question to me 6 months back or 1 year back, I would have said that the space looks a bit expensive, so broad base or diversify and be more in large caps or be more in flexi cap funds. So in a way I have been wrong, and yet you're asking me this question, so I'm grateful that you are. But we genuinely believe that the starting point is never market cap. The starting point always is that what type of businesses are available, where are they in their earnings and business cycle, and what is the price that we are trying to pay for it. And then if the outcome of that ends up giving us large cap stocks, so be it. If the outcome ends up giving us small or mid cap stocks, so be it. At large, 2 things have happened. The small and mid cap segment has also seen a lot of significant improvement in operating metrics. So ROEs look good, profitability has improved. All of that has turned very sharply positive in the last 2-3 years. That has coincided with a lot of money also coming in that bucket. So end of the day, there are 250, 300 stocks which are available for Indian investors via mutual funds or directly to participate in, and more flows in the last couple of quarters going into that bucket is also creating some bit of premium in terms of their valuations. And around the same time, if companies report marginally positive operating metrics, it's only adding to the tailwinds. So I really don't know. I've been wrong last year in terms of predicting that small caps may not do as well or mid caps may not do as well. So I don't want to hazard a guess again. But I personally, this is what I do in my own portfolio. My preference always is in diversified funds. And typically at market extremes, you get into smaller mid caps when there are sharp corrections, or use SIP as a consistent method of investing. Most of our investors have been significant beneficiaries by doing SIPs in our small cap and mid cap funds. And typically when there are phases of poor returns in the last 3-4 years, if you come in at that points in time, your odds of getting better return outcomes are in your favor. That's my view, personal view. But Vineet, if you want to add anything.
Yeah, just one data point. So, we've covered one analysis, a short analysis in this note, wherein we've captured the 7-year rolling return for the mid cap index and the small cap index. And if one looks at that data point, one sees that in the maybe the last 10-15 years for which we have done that analysis. On a 7-year rolling basis, we'll see that the index has provided upwards of 12% return 75% of the times, and 0% returns, the probability is 0. I mean, the history has been 0. So the point which we wanted to make here is, while it at various points we will have extremes created in different categories, the way to deal, one of the ways to deal, because it is going to be very difficult predicting how things are going to turn out, one of the ways to deal is that not to get out of the asset category but to expand the time horizon. So once you have, let's say, 4 categories which are getting expensive, but these are good categories to own, good ROEs, the companies are inflecting, growth metrics are there. Only point is that at extreme valuations, higher valuations, one needs to have a longer time period for as far as the investment decision is concerned, and not maybe lose track of your asset allocation is broadly what we wanted to highlight.
Viewers, it's a very interesting statistic that Vineet Samre is pointing towards, and I just wanted to lay out that point that they've made in that note, that for a much maligned broader end of the spectrum, and everybody likes to say that, oh, mid caps, small caps having run so much, etc., because you are investing into mutual funds from a long-term perspective. That statistic that Vineet Samre spoke about, that they've highlighted, on a 7-year rolling basis since September 12th, the mid-cap index has returned over 12% returns 76% of the times on a rolling basis, has delivered negative returns 0% of the times on a rolling basis. Even for the small cap space, by the way, on a 7-year rolling basis, delivered negative returns only 1.2% of the times. It's a telling statistic. If you're investing for the long term, maybe, just maybe, these statistics would help you make some thoughts. Vineet, just can I ask you a quick perspective, because you guys made this famous decision of not taking investments into your small cap fund at a point of time when you thought it to be overheated. The brave move then as well. Would you say that if you're investing from a slightly longer term perspective on the back of this statistic and on the back of the nature of the market currently, because so many sectors are formed only in the mid cap and the small cap end of the market, it might not be a bad idea to keep your SIPs going?
Yeah, definitely. So that's the thought process that, and then more so when we do this analysis for SIP, this works out to be even better. That investing at a high point also yields to decent returns over a long period of time, and hence from that perspective, I would say that if one really has a good 6-7 years perspective, despite the high valuations, it's okay to be part of this category. The other matrix is that, when we look at our own portfolios, there are still maybe roughly about 40-45% of our investments are still into companies where the valuations are not expensive. The valuations are below 15 multiple even today. Maybe some of them are facing a low business cycle. Some of them are not in the positive momentum or narrative today. But the point is that one needs to create a portfolio which is designed to yield success over the long period of time and have a mix of companies which can potentially deliver good returns when the cycle returns. So I think from that perspective, it's not that everything is sort of over at the moment with these high valuations. There still are opportunities, and definitely one stretches the time horizon to maybe 5-7 years. We don't see a material negativism as far as that decision is concerned.
Okay. Well, gentlemen, stay on. We need to slip into a short break. On the other side of this conversation, we try and talk about one more aspect that they've said. I think 2 more aspects. One is the PSU outperformance, which is probably more than just a narrative, or is it? Let's ask Vineet and Kalpen about this on the other side of this quick break. Stay tuned. right, back with the mutual fund show in conversation with Mr. Kalpen Parekh and Mr. Vineet Sambre, and we are talking about that annual note, learnings from the Tour de France, and trying to understand those or juxtapose those learnings with a thoughtful portfolio approach. Some of the things we've discussed. One important thing that we did want to talk about is this whole excitement around PSUs. Now, Kalpen, I don't want to spill the beans. You guys have mentioned that is the header is that is this whole PSU quote-unquote excitement more than just a narrative? Can you talk about this?
Sure. So, like the title, Niraj, what we are trying to highlight here is that investing has to be a rational attempt, and if data changes and if numbers change, we have to evolve and adapt our opinions and views. So, over the last few years, even at DSP in our portfolios, PSUs which had fairly low weights over the last 2 to 3 years, when they started screening in on 2 counts. One, on account of significant operating efficiencies in their businesses. Second, on account of certain regulatory changes or certain other environmental changes, which gave confidence or conviction on the durability of their business cycle or revenues. We started increasing our weights significantly, so much so that in some of our funds the weights are in excess of 20% in the PSU bucket. Now, an important dimension was that they were also cheap. So typically how do you make money in stocks is, you get significant earnings growth and momentum. And secondly, there is valuation expansion. Now, PSUs were cheap for long periods of time over the last 8-9 years. So if you had entered in the second year or the third year or the fourth year, they were always cheap. But some of the triggers which came out in the last 2-3 years in many pockets, whether it was in the defense segment, whether it is the cleanup on the PSU banking side, or in the energy space, or even on the power side, there were a lot of regulatory changes which also came in, and that coincided with significant improvement and enhancement in business performance. So as money managers, we constantly look for data, and if that data is questioning or making us evolve our beliefs, it's not easy many times when you're anchored in a certain space that we invest only in a certain pattern. The reason to highlight this dimension, so this was also a dilemma that the team keeps on having, that is this for real, is this narrative? And there are always 2 schools of thoughts, 2 sides of a coin. But looking at how data points were evolving, operating metrics were changing, the behavior of these companies in terms of a very high quality business performance, all of that was falling in place and supported by great tailwinds of very cheap valuations. And compare this to a large part of the other side of the market, which was becoming more expensive than what it deserved to be. We decided to gradually increase weights in a lot of these pockets. We've given data points in the note on how ROEs of these segments were in the last 3 to 4 years versus the prior 4-5 years, and how ROEs improved, and they were at starting valuations which are very cheap. So with that context, and like I mentioned in the beginning also, ultimately as money managers, our objective is to buy high quality profits at reasonable valuations, or if at some points in time you get it very cheap also, you get lucky. So I think that is the convergence which is playing out in the PSU bucket. No doubt some pockets are seeing extreme froth, but that's our role as money managers to ensure that the discipline is there, not to buy into them just because there is a PSU rally going on, but each company is evaluated on its merit, and we question that how long is the durability of this growth, and accordingly we decide how to size. Vineet, if you want to add.
No, so I think broadly Kalpen has covered a lot of the points, and more importantly, I think again, going from the fundamental viewpoint, PSU again is a labeling, and when we look at where businesses have created most value, we know that when the growth recovers and the ROEs inflect over the cost of capital. I think these 2 combinations are very powerful for any kind of businesses to start delivering strong outperformance and returns. So I think from that matrix, when we look at these, I think those have added up well. The other important factor is that definitely the past inferences will always remain strong in our heads, and hence the selection criterias for them will also remain rigorous, more rigorous, and wherever we find that dominating PSUs, low private competition, high margin of safety, I think those are going to be the parameters to be part of that basket overall.
Got it. Okay, so Vineet, we're kind of running out of time on the show, sadly. But I just want to ask you, from a mutual fund investor's perspective, how does this, or even the third topic that we kind of looked at, which is where do you guys think we are in the investment cycle and what are the implications for the same? How does a mutual fund investor benefit from the learning around PSUs or from around where we are in the investment cycle?
So I think clearly what investors, I think the most important factor is going to be the rationality, and I think that is going to be the long-term success mantra for investors at large. For us as mutual fund managers, I think this is what we try to look at. We try to look at data to guide our decision making, and data can come from both our team of diverse skill set plus technology, which is also helping us a lot, which we also covered some bit in our note. So I think we'll keep getting guided by those, and as we understand in terms of the business cycles, I think there are business cycles which are maybe towards the higher end of the curve. There are businesses which are still in the midpoint. Many of them are in the midpoint. And there are businesses which are in the low cycle. So let's say specialty chemicals, agri, these are the businesses which are in the low cycles. Automobiles, healthcare are in the mid cycle, and maybe high cycle. Some of these engineering names today seems to be in the high cycle. So I think we need to decipher these segments, need to then compare it to the valuations, and then maybe take a more rational call around how to position or size up some of the good companies within these buckets.
But so therefore, would Kalpen, sorry, just before we wrap up, Kalpen, would you believe that investing via diversified funds, wherein the fund manager takes a call on some of these sectors, be it investment cycle, be it power, because you guys have done some tremendous work in the note on the change in the power space that you guys saw early, etc. Is that the best way to play this? I'm just trying to correlate it from the viewer's perspective about her or his takeaway. Absolutely. After listening to this conversation.
Vineet, Niraj, at any point in time, we believe that the common investor or the average investor who doesn't have the wherewithal to, keep jumping themes and cycles, the best place is a diversified flexi cap or a multi-cap fund, because there the fund managers will navigate. 7 out of 10 times if we go right, that would be a good outcome, and we will keep navigating. The tax efficiency is very high. Left to ourselves as individuals, generally we get excited about a cycle towards the fag end. To give an example, 3.5 years back, we reintroduced a fund called DSP Tiger Fund into the market, saying that the capex cycle could actually be, the valuations looked expensive even then, but the earning cycle had not kicked off, particularly in the capex space. And that, for example, has been the best performing fund in our bouquet of around 15 funds. Today there's a lot of interest in that, but the returns went to only very few people who invested in 2020 or 21. So today, if someone says, I want to put money in that type of a theme, we would say come via an SIP route, because a lot of returns have been made. So our belief is at any point in time, there are different buckets and different phases in the cycle. For an investor, it's best that he comes via diversified flexi cap and multi-cap funds, and depending on his personal asset allocation, decide whether he should do lump sum or an SIP. But clearly avoid hot themes at this point in time, which have run up between 3 to 10 times in different pockets without doing appropriate homework.
Got it. Jayman, we are out of time completely, but thank you so much for writing such a lovely note and talking to us about it. Really appreciate your time. Well,
thank you so much, Niraj.
That's the view from Team DSP. By the way, just mark a couple of stocks there, including Garware, which has had a very strong quarter, and the stock is up nearly 15-16%, so a bit of a bounce there. Some others too, but this one stood out. That's it on this leg of the Mutual Fund Show. Stay tuned to NDTV Profit.